Good morning, everyone, and thank you so much for joining us today. I'm Deborah Acosta. I'm a real estate reporter at the Wall Street Journal, and I'm honored to be here today with these three titans of industry. We'll start with Barry Sternlicht, the chairman and CEO of Starwood Capital. Barry has not only been a pioneer in the real estate investment, but also a visionary in reshaping the global real estate market with his innovative strategies and forward-thinking approach. Next, we have Rob Speyer, president and CEO of Tishman Speyer. Under Rob's leadership, Tishman has expanded globally from the US to Europe, Latin America, and Asia. He's also managed to diversify the company from mostly office to residential, industrial, and life sciences. And finally, we're honored to have Travis Kalanick, co-founder of Uber and the founder of City Storage Systems. Travis is known for revolutionizing transportation, but his current ventures in real estate through City Storage Systems are focused on transforming the commercial real estate sector. Thank you so much, gentlemen, for being here today. Barry, we'll start with you, and we have only a few minutes, so let's start with talking about how you recently made a hard pivot towards developing data centers. How are you looking at that strategy now that DeepSeek is in the picture?
Thank you, and thanks for having me. Well, data centers are probably by far the hottest sector in real estate today. There's no sector of real estate with a 1% vacancy rate and a barrier to entry, which is the power needed to build the centers. I think DeepSeek is, for our strategy and people who are building data centers, is basically irrelevant. Well, it's the strategy we're deploying. We don't really want to spend $100, $200 million in the hope of attaining power, and then we don't get the power, the land is worth nothing, right? So I think what we do, and many of our peers do, is when we can secure that, we have the power, we secure a 15-year lease from a AAA tenant, there are 8 of them today, then it's not a risky investment. So it's not us that's making the decision really on DeepSeek. It's really Amazon, Microsoft, NVIDIA, Meta, Google, ByteDance, and the other major players in the space now, chat. So I think we're not taking that risk. Mostly our approach was to buy industrial buildings in markets that, like Dulles Airport, which is the largest market in the world for data centers. And then our downside was that we had an industrial building. And the upside, and we're building a 450 megawatt plant for basically Amazon right now. Our upside is that we do get that lease, we do secure the power, and we've signed that deal. And so that's and these deals are massive. That's the other problem. They're so big. That deal will be close to $4 or $5 billion investment. So we have about 20 billion invested. We own the largest data center company in Ireland. And we're taking them to the continent. I'm actually more bullish, and you didn't ask this question, I'm a little more bullish on Europe for data centers than the US. Long term, not today. Today the action is here. But they don't have the power that we have. And we have the raw materials, we have the gas, we have the ability to power these new plants that Trump wants to build. In Europe, they don't have the resources to do that. And I think nuclear is a little bit way off, maybe 2032. And the whole landscape could change by then. But right now, the US is by far in the lead. It's part of our exceptionalism as a country, is the growth. The cumulative spending of these 7 mega players is levered as nearly $1 trillion. It's as big as the infrastructure fund. And it's creating an exceptionalism to our GDP that the market doesn't talk about. It's not the whole economy that's doing so great. It's just this entire race to data centers and to AI and deployment of it. And it is a race. It is an arms race between these Microsoft, Amazon, Google, and the rest of the guys. Oracle. I should have mentioned Oracle. So we've done transactions with almost all the majors now, all over the world, and there are a lot of people deploying a lot of capital. It feels frothy, but we're not driving it. If we can't get the lease, we won't build. And that's really, the money goes in when you go vertical. So if you don't go speculative, and it's really interesting, the newest thing that's happened, it's evolving so quickly. The utilities are, everyone and their cousin, I have a couple kids, they find a piece of land they like, they put it under option, and they go approach the utility and say, we need power. The utilities are basically saying, you got to pay $1 million to apply, so my son's out. He doesn't have his money yet. Or now they're saying, I'm going to give you power in 4 years for 15 years. It's a take or pay contract. You have to put up money. So in some of our transactions, saying you have to put up $60 million today to secure the power. That is going to change the playing field. There'll be 10 of us instead of 100 of us being able to play in the space. So it's going to be interesting. And the big question in data centers is our exits. We don't know exactly how we're going to get out of buildings that are worth $10 billion and on a yield basis. So I think that's sort of all scratching our heads a little bit, and we expect these companies to go public. But it'll be really interesting to see how this evolves.
Rob, speaking of pivots, Tishman Speyer has been known for being a big player in the office space, part of the industry. How have you all pivoted to respond to some of the changes in the market lately?
So as you mentioned, we've significantly diversified the company beyond office into residential, industrial, and even into data centers, where, to Barry's point, we recently did a deal in Frankfurt to convert an old industrial park into data centers. And importantly, we're doing it in a 50-50 joint venture with the power company of Frankfurt, because more important than the real estate is knowing you're going to get the power. But to address the office question, don't sleep on office buildings if they are well located, high quality in global capital cities. If you look at many global capital cities around the world, rents are higher and vacancy rates lower than pre-pandemic. It's true in central London, it's true in central Paris, it's true in central Munich, it's here in Miami, Barry could tell you about that, and it's true in my hometown of New York City.
Tokyo, Seoul, all the Singapore, fantastic office markets.
But in 10% of the office
In the
buildings.
high, it's what we traffic in.
Yes.
It's in the high quality, well-managed, well-sponsored office
The best
buildings. If
buildings.
you need 1 million square feet in Midtown Manhattan right now, you can't find it, and guess what? It's not going to deliver for another 5 years. There's actually a scarcity in some cities of really high quality new office buildings, and so I think there's a real opportunity there if you pick the right locations and obviously get it at the right basis.
What cities are you looking at to expand office?
I mean, New York, and we wouldn't be alone in that. And in Europe, we've been aggressive at playing this theme, again, in the right locations for really high quality product. And because we're super close with our customer base, we know what they want, where they want it, and if everybody else is going that way, it's probably a good time to be going this way.
This is a quickie. I mean, Munich rents were up 15% last year. So it's a 2% vacancy rate. And we're active in Munich.
In those very, very
in the good
tight
buildings.
spots. It's,
Yeah.
it's not even
Class A.
It's not even a city. It's like a neighborhood, and then you have to go. Okay,
can
those
insult the
guys are the
Germans.
have-nots. These guys are the haves.
It's called knowing what
No, I know. I got you. There's a lot of have-nots. Like I'm in downtown LA.
That's
and
a disaster.
But it was a disaster in the 1980s when it was built.
It'll
That
stay
has
a disaster.
always
saying
been
I'm paying $1.75 a square foot right now.
I have a few things I could sell you, Travis, if you want.
I'm ready. Let's go.
Let's go.
Travis,
kitchen in.
speaking of distressed real estate and looking for opportunities, during the pandemic, you picked up a lot of properties all across the country. Is that right, with your Ghost Kitchen initiative?
Yeah, I mean, it was really around the world. We're in 30 countries, so there was a lot of interesting stuff happening. We started the company in 2018. By the time COVID happened, we could not build enough kitchens, given that so many restaurants couldn't operate in their normal way. So we were picking up real estate everywhere, and actually, our demand was like this, and the pricing on the real estate for a short period of time was like that. So it was a good time to buy. But then, of course, there's the years after where COVID goes away and people come back out in the world. And then you're like, okay, how do I keep all this pipeline of real estate that's going live? How do I keep it full? And that was there's sort of like a very interesting dynamic in 22 and 23. Yeah.
Speaking of distress, Barry, I think you're the king of distress and taking opportunities in distressed markets. You did it here in Miami, also when you started Starwood Hotels. Where do you see those opportunities right now as the real estate market goes through this change?
I think in Rob's theme of being a contrarian, we had our busiest year ever buying in Europe last year. I mean, because Europe marked down faster. The banks didn't play games, they didn't extend and pretend, they just cleared things. So we bought an office building in Dublin. It was built for 175 million euros 4 years ago. It was 65% leased. The loan was 125 million. It was a West Coast money manager, you all know. And we bought it for 80 million and they financed it. So it's 40 cents a replacement cost. So we're trying to like find opportunities like that all over the world. I mean, I think hotels, they're cheap. They're almost double-digit cap rates in some cities. But it's really, and also even basic asset classes like apartments, because prices of rents have flatlined and debt costs have gone up 500 basis points. You can buy apartments today, probably 65, 70 cents a replacement cost, and you're looking at overbuilding last year, 600,000 units last year, 530,000 units this year, 230,000 units in 26, and 200,000 units in 27. So you know rents are going to have to go up to justify new construction. So you could say it, and people are distressed in apartments. They cannot refinance their debt, right? They built these projects for a different interest rate environment, and as these construction loans mature, they can't rebalance, especially if it's in a little limited partnership. The partners don't want capital calls. So we see a lot of distressed syndicators and the multis. You've seen the same in most every asset class. As soon as the loan matures, it's an explosion because either they come up with more money to pay down the debt, they cannot keep the same amount of debt given where rates are today.
This is such an important point because the supply cliff that every sector in real estate is facing in 26 and 27 is going to cause an inflection where rents are going to take off. And so if you can buy today below replacement cost, finished assets are
relevant assets, good assets.
Good assets. But if you have the capital to build at a time when there are very few competing with you, that's obviously a sweet spot. So we're building 2,000 apartments across the Hudson River from New York City because it's impossible to build in New York. If there's one inspiration we all ought to take from what we've heard is happening in the kingdom, and you heard Jerry present Doria, which is an incredible project, we've got to do more building here. We've got to figure out how to create more infrastructure, how to create more real estate. If we don't, we're going to see inflation take off. Well, it's great for those of us who own finished buildings. It's not going to be so great for
relevant to this is, of course, tariffs, because we have a 5 million unit housing shortage. And our lumber, a lot of it comes from Canada. And that means prices are going to go up. We're not going to be able, and people can't afford houses today. So it's a lot of these, and steel, same thing with steel. If steel prices go up, you put tariffs on steel, domestic users or suppliers will increase prices because they're protected. So we'll see how this plays out. Just in distress, another example, in London, we bought 11 hotels downtown in the city of London from an Indian fellow whose family owned them forever. But he got completely upside down with a new project he started and the pandemic blew him up. He borrowed a ton of money. He's paying 12%. So he tried to sell us a very beautiful site in Mayfair, but it was too expensive. But he had to sell, so we bought his cash-flowing hotels. And I think we bought them at a 9 yield, unlevered. The market for those will be 5. So, but that's like, you got to go. You got to be in the fray. You got to find these things. But, you got a lot of people. We've been doing this a long time. So you see things like that. It's pure distress. But there isn't as much as you would have expected. I think we'd all say in the United States, like, we know these office buildings are worth 60, 50 cents on the dollar. But in our own portfolio, we have a $300 million asset in Atlanta. It's a trophy building. It's not worth the debt. And the lender said you could pay us down $5 million and you get 5 years. So you saw a lot of that. I call that extend and pretend. And we'll see what happens in 5 years. And for us, we put up the $5 million. It's an option, right? We'll see how the markets evolve.
Rob, you mentioned that, in the high end of the office sector, things are great. But what happens with all those midtown buildings that are groaning under the weight of these very large loans and not a lot of people going to the office? What's the reality there?
Yeah, so you'll hear the narrative that 3rd Avenue is the worst place to own in Manhattan. We own a building on 42nd and 3rd Avenue. We invested a bunch of capital the last couple of years to make it feel high quality, but also to provide the experience that our customers want in the building. And we took that building to 100% leased. And so I think a real opportunity is buying older buildings, but then giving it the attention and the engagement that customers want. We own Rockefeller Center. It was built 100 years ago. It is still the premier real estate asset in the world. It's also nearly 100% leased. We did the largest single asset financing in the history of the CMBS market a few months ago. Nobody thought that we would get either the proceeds or the interest rate price that we were able to secure. So what I would say
How
is
big was
like,
that?
if $3.5 billion.
Secured by some of the buildings in Rock Center?
Just Rockefeller Center, and then we did another
Barry's
financing a week
interested.
ago.
Barry needs
2
some
weeks ago
access.
at $3 billion. So I think like a real theme you'll hear is when everybody is going this way, you want to go that way.
I have to press you though, because some of these buildings, Rockefeller Center, that's one asset, but what about these massive structures with these huge floor plates that nobody knows what to do with? That's the reality. There's a ton of that in Midtown Manhattan right now.
Yeah, look, in any business, you don't want to own commodity assets. You want to separate yourself from the competition, and real estate is like no other operating business. It's not a passive business. It's not a business that you can buy something, think you're securing a cash flow forever, and treat it like a bond. I think it's one of the mistakes people make when they think about real estate. They compare it to fixed income. It's an activist business. You need to know what you're doing.
What's interesting on commercial office is that there really are haves and have-nots, and the haves are like 10%. And if you go to a have-not, it's like a ghost town. It's like zombie apocalypse. And even if you have really cheap leases, most CEOs, most executive teams do not want their people to be in a ghost town because their people don't want to be there, and they're trying to get them back to work, back to the office. So there's a herding effect towards these high-quality centers. And that's where the haves are. And so if you can figure out as the high quality centers grow, or the number of these buildings have to grow because more people are coming back to the office, if you can figure out the frontier between the haves and the have-nots, you can start finding some interesting stuff. I'm guessing that's what you're doing.
Take a big picture for a second. If you look at, there's not a city in the United States where vacancy rates aren't 20% or more. Austin will hit 30%. And in Europe, you can't find a major city with a vacancy rate above 5%. So, and same is true of the major cities in Asia, except for China. China is a disaster.
Okay,
But in 20% vacancy rates, Park Avenue is like a 6% vacancy rate. So there are pockets that are, that are in high demand, and your job is to read the headline and go find the opportunity. I love bad headlines. It keeps all the capital away.
But
right?
the problem
we
is
actually want it.
You still have these vacancy rates that are low in many cases, but the physical occupancy rate is like 20%.
It's changing.
25%.
It's getting better.
That's old news. I mean,
it's not old news. Just go to most office buildings
I'll
in
tell you,
most
you're
cities.
in San Francisco. You're
in the
spent
tech
a lot of
world.
time in San Francisco. We have competition right now for a new building that we developed in San Francisco.
That's of the 10%. I totally get it. But if you go there on a Friday, tell me what you think the physical occupancy
But if they're
is.
there the other 4 days of the week.
Okay, so now it's
not
the
sure
4 days.
Miami's the highest
that's far from
occupancy in the
20%.
country. We are the #1 city for office occupancy in the country. It's like 85%. I don't know why. Commutes are awful. And it's the only city in the country where mass transportation rates are higher than pre-pandemic.
Okay, just for kicks, how many people here go to the office on Friday? Raise your hand. Okay, that's like 30%.
Well, maybe the restaurant on
Okay,
Friday.
how many people go to the office on Monday? Raise your hand. 50%. Okay, so now your building that used to be occupied 5 out of 7 days is now occupied 3 out of 7 days. That is a less useful asset.
But unlike a restaurant, you can't do your pricing a la carte. It's not like people are paying rent for an office space at lunchtime, but then get out of that rent at 3 o'clock in the afternoon.
I'm just saying.
that's WeWork.
I'm just saying. Watch your back. It's going to get weird. That's all I'm saying.
Oh God, Travis. So where are you focusing your energies, if not in office? It sounds like it's more in these spaces that you've purchased for ghost kitchens. But as we all know, ghost kitchens are not really as exciting as they were during the pandemic. So how are you pivoting? Where are you looking? What are you doing with all that space?
Yeah, so look, the online delivery market continues to grow. It is growing double digits year over year. That's a good thing. But you have to serve your customer. Your customer, if things were hopping during a COVID time period and then you go back to the real world, back to normal, you say, okay, how do I create demand for your customers? So we actually do a lot of stuff with offices actually that need food. And we allow them to get almost like an Uber Eats or DoorDash-like experience because we have this dense production in our facilities that have like 30 kitchens each, and you have dense consumption Tuesday through Thursday. We then can move food with a Uber Eats or DoorDash experience, but with one courier moving 100 orders at a time. So you take the courier logistics out of it. They get the personalization, the selection, but the courier costs are out. So now you go, I get the cost of going to any one of the restaurants that, okay, I had to go down the elevator, out to some food court, and then come back, which is like a 40-minute experience. It just comes to me on my floor on a shelf. So it's like systems like that that create demand. And then it's how do you labor is a big problem in the restaurant world. How do you turn labor into real estate? And what I mean by that is we have a robotics division. Our food production robots are rolling out in our kitchens all this year. And when you do that, and you can prepare food in the morning, and then your entire staff leaves because the robot runs the delivery kitchen from noon on by itself, you then can charge for that machine and real estate combination, and you're turning labor into real estate. The same way real estate normally turns marketing into rent, you can do that on labor in an industrial context. So those are the types of things that we're doing.
It's super exciting, really interesting. Thank you all for being here today with me. I really appreciate your time. Thank you.